Hello, everyone, and Happy New Year. Welcome to our 2024 Market Outlook. The overarching theme for today's presentation is cooking, and we'll be embarking on a unique culinary journey through the world of financial markets. Here is an overview of the 7 topics we will be discussing in today's presentation. First, we will be starting with the U.S. economy. Many parts of the economy have been rotating from hot to cold over the last few years at different times. For example, if we look at the last 2 years, there have been certain areas that have been doing very well. Let's take a look at the gold and silver lines. Air travel spending has been up 194% and leisure and hospitality up 41%. These are things related to the services we have all been spending on. Think about the Taylor Swift economy where we had concerts, taking vacations, dining out, and going on cruises. We think this growth is likely to slow down as we progress into this year because consumers have less savings, student loan repayments need to be repaid, and we are starting to see some cooling of wage gains. As the blue lines on the chart show, not all parts of the economy are the same. Existing home sales are down 44%, and manufacturing has been contracting over the last 2 years. However, our economists believe we are at the cusp of seeing some of these areas starting to bottom. Particularly if interest rates get cut, that could potentially start to stimulate the growth for these areas, which will offset some of the weakness we are likely to see from consumers. This rotation in the different sectors of the economy is one of the reasons why we don't see a major recession unfolding this year. When it comes to the economy, we focus on the consumer because it represents 70% of GDP. And when we look at our real-time indicators, the consumer is starting to show signs of fatigue. For example, we are starting to see the employment market slow and a small uptick in jobless claims. Services related to spending and restaurant performance are starting to slow as well. Another indicator is luxury watch prices. They are at a 2-year low, which is a sign that demand is starting to cool. Another thing we want to highlight is that, contrary to what people believe, recessions can occur in an election year. In fact, 3 of the last 13 recessions started in the last year of the first term of a president, so it is not uncommon. Our official forecast is for a very mild recession. By historical terms, perhaps even a soft landing. An average recession is when the economy experiences a decline in GDP growth of 2.5%. We are expecting this year's GDP growth to contract less than 0.5%. So in the end, the 2024 recession may be so mild that many may even barely notice. Here are a few reasons why we expect this recession to be mild. First, we don't see any major economic shocks on the horizon. Second, when it comes to job losses, we think we are going to have some, but it won't be any substantial amount. Next, positive government spending from the Inflation Reduction Act and CHIPS Act means money has already been set aside for spending this year, which will support growth. Labor productivity is also at an all-time high and more efficient. Think about investments that have been put into place from companies to enhance their technology, particularly with AI and automation. A lot of that will help alleviate some of the pressures of the economy and help us continue to grow. Lastly, we had a great rally last year for the equity and fixed income markets. Because of that, household net worths are currently at record highs. When people feel wealthier, they tend to spend, which should support GDP growth. Next, to our second theme, the Fed, led by top shelf Jerome Powell. The Fed will have a big say in the outcome of the economy this year. At the December 2023 meeting, the Fed appeared to have ended their tightening cycle, with the next move likely to be a rate cut. Let's keep in mind the Fed has 2 mandates. First is stable prices, which is inflation, and second, a robust economy, which is usually viewed through the lens of full employment. When it comes to the first mandate of containing inflation, the Fed appears to have done its work. Inflation peaked in 2022 at around 9%, and currently, as we stand here today, it's at about 3%. Goods prices have also started to decline. One of the reasons is that because the supply chain constraints have been resolved and have come back to normalcy. When it comes to pricing on services, it's a little bit more mixed. We've seen some decline on health insurance, utilities, and airfare. One sector that remains elevated is rent and shelter costs. However, the Zillow index is starting to show a decline, which is why we believe shelter costs will begin to fall this year. So the first mandate for the Fed of inflation appears to be under control. For the second mandate, and looking at the economy, the Fed is hearing from businesses that the economy is slowing. And when you look at the employment data on the left, you can see that the labor market is starting to see some softness when it comes to job openings. Our economists believe that job growth could turn negative with job cuts starting the second quarter of this year. The one caveat is that this is going to be a mild correction when it comes to the employment conditions. Our economists forecast in total about 1 million jobs being lost, which is far less than the historical average of 3.5 million jobs lost during a recession. Many ask, how can the Fed cut rates if inflation is not down to its goal of 2% and job growth remains positive? To answer that, we like to look at historical data. In the chart towards the left, it shows that 8 out of the 9 times the Fed started to cut rates before inflation was at their goal of 2%. If the Fed has confidence that the trend will continue downward, they can start to cut rates before it actually hits 2%. As for job growth, 3-month average job creation was still positive at the time the Fed first cut rates. Another question many ask is, will the Fed cut rates in an election year? Yes, there is a precedent for that. The Fed, which strives to be independent and apolitical, has cut interest rates 62% of the time during an election year. We believe the Fed will cut interest rates at least 3 to 4 times this year, starting around the middle of the year. We are forecasting a cut of 25 basis points in June, July, September, and December. More significant interest rate cuts would likely be a sign that the economy is much weaker than our forecasts.
And on to the third theme, where we compare the fixed income to the show Bar Rescue. The host goes behind the scenes of restaurants to give them makeovers in hopes of it being more successful. We see the same with fixed income. Bonds still have not recovered its losses from 3 years ago, but with a little bit of a makeover with the interest rates, they are once again attractive. In almost every sector here, bonds have risen compared to the time during COVID. And as an example in this chart, munis were below 1% and now they are at 5.4. Investment grade bonds were at 1.7 before and now they're at 5.1. We expect interest rates to continue to move lower. The 10-year Treasury are at 4.0 right now, but we expect it to drop to 3.5 at the end of this year. There are a couple of reasons for that. We expect a slow in the economy or mild recession. We believe inflation will decrease. And history shows that when the Feds have their last rate hike, interests tend to fall. On the left, the last rate hike was last July, and we are in the window of 5 to 12 months after that hike where the interest rates are falling. Here's another way of seeing it on the right. In between the last rate hike and the first rate cut, the rates tend to move low. Once we get the first rate cut, after 12 months, we see the rates continue to lower. With the recent rate rise in interest rates, it puts the bond market in a better place for potential for losses if rates go higher. During COVID, when the interest rates were low, if we saw a 1% increase, the bond loss would have been 9%. But now that interest rates have risen, there is a larger buffer because of the higher coupon payment. If there is an increase now by 1%, the loss would be only 3.7, and it's a lower downside risk. So the overall bottom line, bonds have a much more favorable risk and reward profile given the rise in interest rates. When it comes to sectors, we still prefer the high-quality bonds over the junk bonds, and that's mainly because of pricing. High-yield bond spreads are just not priced for a mild recession. When there is a recession, that's when you start to see defaults and bankruptcies. 50% of these lower-tiered credits are at a risk of a downgrade, and it would be a negative impact on the bonds, and that's why we still prefer staying in the higher-quality bonds. And now we turn to Gordon Ramsay's equity markets. We all know that Gordon Ramsay is a perfectionist in the kitchen and just does not tolerate any mistakes. So just like the equity markets recently, there's very little room for error as we go into 2024. One of the ways we determine our S&P 500 target is multiplying the earnings per share by the expected multiple at the end of the year. Our earning forecast for the S&P 500 for this year is $225, but the consensus has it at $245. So why do we expect the figure to be lower? A couple of things. We still believe we are going to have a mild recession. There's going to be increases in revenue, and there's going to be stable margins as a lot of companies already started to cut expenses. And also in this chart, history shows that the consensus numbers lower on average by about 4% on this left-hand side. That's because analysts tend to be more optimistic towards the beginning of the year and overestimate. For valuations, we don't see the PE multiple expanding this year. And the chart in the middle shows they are elevated a little bit from 2023, but if we exclude the time of the shutdown during COVID, valuations are at the highest levels over the last 20 years. So overall, our target for 2024 comes to be 48.50 for the S&P 500. That's a 2.3 price return, and that's a 3% upside from our target for 2023. We are optimistic for 2024, and the reason for that is through history. In the last 11 re-election years, the market has moved higher and is up on average around 13% on the left. During the 1 year surrounding the first Fed cut, there is an 8-month period where the market is volatile. And in 2023, we saw an incredible 25+ return. Usually we would think there's no way that could continue doing so well, right? But on the chart on the right, historically after a 25% plus return, the next year is positive 70% of the time, and that's an average return of 12%. So as an outline, our target for S&P is 48.50. We know there is a bull scenario and a bear scenario. We believe that the biggest impact to this will be Fed's action and its impact on the markets. On the right here, it shows us that on average, when the Feds start cutting, the markets end up slightly positive, and there is not a recession. But if the Fed's cutting is late and they come into action too slow, then we could see a recession.
Doing a deeper dive, we believe we're in an environment where earnings growth is likely to be challenging. And with that, we want to be in sectors that can continue to evolve and drive their earnings higher. Our Michelin star rated sectors, or our favorite sectors for the upcoming year, are technology, healthcare, and industrials. Starting with Infotech, we're excited about it because we think we're still in the very early innings of the artificial intelligence theme. This chart on the left displays that there are currently about 50 million people worldwide using AI. And this almost straight line up projects that the adoption rate will accelerate and that by 2030 we project over 400 million people will be using AI. To this point, companies have been very focused on building out the infrastructure, so chips, data centers, clouds, and networks. The next step will involve the development of applications that benefit our lives. And looking at this chart on the right, the tech sector continues to maintain the highest margins of any other sector. Now, without a doubt, tech had the largest outperformance last year, which begs a very valid question. Can it maintain that momentum? If we look at the NASDAQ on the right here, which encompasses most tech-related stocks, you would see that tech stocks had a great year last year, but you'd also see that the year before there was a significant decline. In fact, if you go back over the last 3 years, the NASDAQ is actually down 4%. Meanwhile, earnings over that same period have gone up 8%. You could make the argument that tech has actually gotten a little bit more attractive than it was a few years ago. And even more surprising, if you look at the performance of the S&P 500 versus the NASDAQ on a 3-year rolling basis, the S&P has outperformed by 13%. The second sector we like is healthcare, especially after its underperformance last year. There are drugs in development or under review to not just help with obesity, but also other diseases like cancer and Alzheimer's. And with people continuing to live longer, we anticipate that healthcare needs will only continue to grow. Fundamentally, we believe healthcare will be one of the leaders for earnings growth this year. Not only will it be one of the leaders for earnings growth, but we also think it's positioned pretty ideally as both offensive and defensive. Over the past 5 years, healthcare has had the second highest earnings growth while having the third lowest volatility. The third sector we like is the industrial sector. Thanks to the US government incentivizing companies to manufacture here at home, especially for products with security concerns like semiconductors and pharmaceuticals. And while there's been significant government funds allocated to this through the CHIPS Act and the Inflation Reduction Act, much of that money has yet to be distributed, but we expect that to change this year. And from a fundamental perspective, the manufacturing sector has been in contraction for 14 months. It's our belief that we're close to a bottoming. Historically, when the manufacturing sector bottoms, industrials rally on average 30% over the following 12 months. So no surprise here, but we think that volatility will be turned up this year, a lot of which we think has been created by the current perception of risk in the market. Looking back last year, there was a lot of negativity going into 2023. There were predictions of a mild recession, inflation, or higher for longer. A lot of economists projected a negative year for the markets and for earnings to decline. Well, if you look at what actually happened, there was no recession. Earnings not only failed to decline, but they accelerated. There was a significant deceleration in inflation, and the markets were higher as earnings grew to a new record high. Comparatively, as we sit today, it's quite the opposite. There's elevated expectations that don't quite match up with our forecasts. There's a lot of optimism for the year. There's expectation for a soft landing or no recession. They're projecting 6 rate cuts. Consensus S&P 500 targets are at or around 5,000, with earnings expected to come in at $245. We're on the more cautious camp, I'd say, definitely more cautious than the majority. We think we'll have a mild recession beginning next quarter. We think the Fed will likely only cut 3 or 4 times this year, and we're much more conservative in our earnings projection at $225. As the market comes to terms with expectations being a little bit too optimistic, we'll likely see volatility as these expectations are reset. Geopolitical risk will undoubtedly also heighten volatility. That shouldn't come as a surprise given what's happening in Israel and what's happening in Ukraine. And that doesn't even include what could or what might happen in Taiwan. In the US, we're also setting up for another very interesting election year. Historically, election years have higher levels of volatility. And to illustrate this point, this light blue line tracks volatility month by month through a regular year. These darker bars are volatility through election years. And our final theme is a familiar one: staying true to the asset allocation that your plan calls for and not chasing returns. So you've seen this chart before, the one we affectionately call our jelly bean chart. It goes back to 2006 and it ranks in order from best to worst asset class performance. And in the middle, we have a blended portfolio. We did an analysis of 3 different scenarios, scenario 1 being a momentum scenario. So in this scenario, we take whatever the best performing asset class from the previous year, we take all our money and we invest it there for the coming year. In the second scenario, a contrarian scenario, we do the opposite. We say, what was the worst performing asset class? We take all our money and then we invest into that for the coming year. And then we have a blended portfolio, 60% equity, 40% bonds, that remains fairly static from year to year as we rebalance. Let's take a look at the outcomes. If we took $100,000 and invested it in the momentum portfolio, so taking all your money and adding it to the best performing asset class, you would have been down 4.9% over that 18-year period. Your $100,000 would have shrunk to $40,000. If you went down the contrarian path, so taking all the money you have and investing it in the worst performer from the previous year, you would have done a lot better, at least turning a small profit of 1.1%. Your $100,000 would now be worth $121,000. With a blended 60-40 portfolio, you would have earned an average annual return of 6.2%, which looking back is pretty good, considering we had the great financial crisis and the impacts of COVID. Your $100,000 portfolio would have grown to almost $300,000. So the point is, sometimes letting your portfolio marinate and staying true to your asset allocation is often a better long-term strategy. The reason this is important, one of the things that we think could be a potential spoiler for the markets this year is the dynamic of investors tending to follow the winners or using that momentum strategy. With US large cap equities being the top performer last year, it attracted a lot of fund flows. In fact, the SPY ETF had its largest monthly amount of inflows on record. If we look at the table to the right here, it shows the previous 20 largest monthly inflows. And what you'll see is that historically, on average, the performance is flat to negative during the coming 3, 6, and 12-month periods. Now, clearly that's not always the case, but it's important to stay poised here, as we believe a lot of the good news has already likely been priced into the market. And with that, we want to thank you all for tuning in. And more importantly, thank you all for your partnership and your trust in us. We'll be reaching out to each of you to schedule your first quarter strategy meetings, but in the meantime, please don't hesitate to contact us with any questions or if we can be of service. Thanks all. Have a great year.